FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 1/9/20. Well, if you thought 2019 was a huge blockbuster year, well, just wait for 2020. It might not be as good, but the person you're about to hear from thinks it's going to be a pretty good year with double-digit returns and lots of other great things. No recession in the offing. What's your opinion? What do you think 2020 is going to be like? We'd love to hear from you. Why don't you email us, kl@kerrylutz.com. That's the email address. Eddie Ghabour is with us, a frequent guest of the show. Eddie, you were upbeat about last year, and you're pretty upbeat about the coming year ahead.
I really am. I mean, I've been bullish for quite a while. Fortunately, knock on wood, as I'm knocking on my head here, we've been correct in our market calls. And I don't think it's going to be a repeat of 19 for 2 reasons. Number one, 2019, there really wasn't a ton of volatility. Markets went straight up and pretty much asset classes across the board. If you didn't have a great year last year as an investor, you probably never will if you were in the markets. I think as we head into 2020, you look at the backdrop, why I am bullish, and I feel like, in my opinion, we're going to have the potential for another double-digit return on the market is a couple of factors. Number one is the Federal Reserve is not going to raise rates in 2020. I feel firmly with that. They're going to continue to do whatever they have to do to keep rates low. That's a very bullish thing from an investment standpoint, because when you look at the 10-year bond, who wants to lock their money up for 10 years and get 1.8 or 1.7 or 2%? Secondly, until we have a recession, I don't see this bull market ending. And with the labor market as strong as it is, I do not see a recession in the cards in 2020. Couple those 2 main fundamental factors with the fact that there's a ton of cash on the sidelines from retail investors who continue to not believe in this bull market. And that is a perfect scenario, again, in my opinion, for this thing to continue to carry on, because we have yet to have that euphoric state where retail investors kind of throw in the towel and say, okay, I might as well jump in and get some of this action and put my cash to work. We haven't seen that yet. So I've been saying this for 3 years now. This has been like the most hated bull market in history because everyone keeps trying to find a reason why it shouldn't be going up. And I'm on the other side of that.
Yeah, it's interesting. It has been hated since it started in 09, 010. Nobody has been a fan of this bull market, and yet it keeps on going up. You know that old saying, stocks climb on a wall of worry, right?
That's exactly right. So selfishly, I hope the pessimism continues for several years, because chances are, if that pessimism is there, that doubt is there, that is a very bullish sign for equities. Now, I think for 2020, you need to prepare yourself for volatility. Last year, we got a little bit too complacent, in my opinion. I think 2020, although I believe it's going to be a good year, I think the path getting there is going to be quite choppy. We've got an election this year. We've got the Middle East issues that are going to be happening this year, as well as other things that will pop up on the radar that we don't even know about. So it's going to be a choppy year, but I think it can be very rewarding for investors.
Yeah, and so you just got to stay the course, huh?
That's it. Stay the course and rebalance your portfolio. My concern for investors is after the big year they had last year, they may be overweight certain sectors that they shouldn't be. And if you don't rebalance your portfolio to fit your risk tolerance, then you're susceptible to major drops. And when that happens, people usually make an emotional decision and sell out at the wrong time.
Yep. And they zig when they should zag, and they zag when they should zig. And so what do you think about the debt, though? The debt shows no sign of being gotten under control.
Look, that is a major concern for me long term. You know, I am very old school, and I think debt is one of the worst things that people, companies, and countries can accumulate, because there's a day of reckoning when you accumulate debt. Okay. So from a stock market standpoint, the debt issue is not going to impact the market in the next few years, because I don't think there's going to be an issue in the next few years with the debt, with the rates being as low as they are. But make no mistake about it. As a country, I feel like we are heading down the wrong path in regards to debt. And eventually, you do have to pay the price if you get too irresponsible fiscally. And if rates were to shoot through the roof and inflation were to happen, which eventually will happen, and our debt has not been tamed, then we're going to have to ask the question on how the hell we're going to pay for this. And so that is a long-term concern for me that I have for my kids, is if we continue borrowing money at the rate that we are, we're going to put ourselves in a very, very tough position financially as a country.
Yeah. Yeah. Well, have we gone too far? Have we reached a tipping point, though?
Not the tipping point yet, because they still can do some creative things. You know, we've heard about them coming out with a 50-year bond that supposedly is in the works. I mean, there's different, I'll call it creative financing you can do to kick the can down the road and delay the inevitable. But at the end of the day, it's just like you or I. If you get too over leveraged, at some point in time, your cash flow is not going to be enough to pay that debt, and you go bankrupt. And it's no different for a country. It's just like it's no different to a family or a company. So they can do things to delay it, but at the same time, that balance sheet still shows that much debt. And that's a big, big concern for me long-term for this country. We need to get that debt under control.
Yep. Agreed. And, well, I don't know what it's going to take. Trump certainly appears to have little or no interest in restraining it, and neither does anybody else in Washington. You never even hear anybody talk about the national debt other than Democrats when they want to bash Trump.
Yeah, and look, there's a plenty of blame to go around with all this debt, you know, and people just need to look at the facts instead of pointing fingers at one another and recognize that as a whole, it makes common sense tells you that when you're carrying that type of debt load, that you don't need to be a Harvard graduate to understand that that's not fiscally responsible to do that. Just like we wouldn't tell our kids to go out and max out credit cards because it doesn't make sense financially and it will lead you down a wrong path. And that's basically what we're doing right now, printing money and spending money like drunken sailors.
Yeah. Well, don't insult drunken sailors like that. I think they're a lot more responsible than who we have running the country. Maybe we'd be better off with some drunken sailors, but
never know.
But really, like, and what you said, yeah, like Harvard grad or post grad really doesn't understand debt. They believe in this modern monetary theory, and like all good things, the gravy train at some point is going to come to an end.
It is, and it's an ugly scenario at the end. Look, when money is cheap, people take more risk. You look at companies right now. There's a lot of companies are carrying a lot of debt right now because rates are low. You know, my concern is households may be doing that because interest rates are so low. People keep saying, look, rates are so low, just borrow as much as the bank will give you. Well, that may sound great in theory, but at the end of the day, what happens when your cash flow isn't what it needs to be to cover that debt? Then you go bankrupt. And that can happen to a country. I think sometimes we can get a little bit too arrogant and think that we're bulletproof, and we're not.
Yeah. Yep. So what about what's happening with the Middle East and Iran killing that the number 2 guy there? What's your thoughts there?
Look, I don't think this is going to go away anytime soon. You know, and it's going to be interesting to see, you know, what we're going to do in regards to any type of further military action. I hope that we don't go to war. I don't think anybody wants to do that. But at the same time, if American lives are lost, I think you're going to see big retaliation on our part as a country. So, you know, we can only hope and pray that what's happened here recently will kind of calm down a little bit. But at the same time, I think this geopolitical risk is going to be a dark cloud over the market, and it's going to continue to rear its ugly head throughout the year. That's why I feel like this year is going to be a very volatile year, because it's not going to go away. Couple that with China as well, too, and what other countries may do. You know, we do have major geopolitical risks right now.
Mm-hmm. Yep, we certainly do that. And then when we look at Brexit, so what's your take on Brexit? It seems to be like a big nothing here.
Right now, the market doesn't seem to think that it's going to be an issue. And I think the reason why they're ignoring it is because there are bigger issues right now impacting the markets. You know, I tell you one thing that could catch some people by surprise is, we're supposed to get this phase 1 trade deal signed, sometime mid-January to third week of January. Well, my concern is, what if it doesn't? What if the Chinese decide to back off a little bit, or we do, and that deal does not go through? I think you're going to see a major downdraft in the market if that's the case, because it's fully priced in. And you and I both know with this China and U.S. trade issue, we've come so close so many times, and when it comes time to put pen to paper, something falls through. Now, I'm not saying that that's going to happen, but I'm telling investors that is a risk. Don't just assume it's a slam dunk because you heard it verbally.
Yeah. Yep. I agree. Anything could happen. The Chinese are going to act in their own interest. And if it's in their interest, they perceive to not make this deal, then they won't make it. But on the other hand, they've already picked up their agricultural purchases like they had a choice. And it looks like they're starting to implement the deal, even if they haven't signed it yet.
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Yes, and that's why, the likelihood of them backing out right now is not strong. I do recognize that. The market recognizes that. I guess I'm just being a little bit more cautious because of the track record in regards to that. And then after it's signed is, making sure those things that are in that deal are actually followed through with and actually done.
Yeah. Yeah, well, trust but verify, in the immortal words of Ronald Reagan, right? Because you can't trust any of these guys. Can't trust the U.S. either, but at least we, in theory, stand for carrying out agreements, upholding them, right?
That's exactly right.
Yeah. Yeah. So what's next here? What sectors you think are going to be the biggest beneficiaries here?
Technology is going to continue to do well, in my opinion, especially anyone that's going to have any type of, the chip stocks with this 5G implementation, expecting chip sales to go up. They should do well. I'm old school again. I love dividend stocks. One area that got beat up last year was the oil sector. I think you can find some nice oil stocks that pay a good dividend that's more than twice the rate of the 10-year Treasury. Anytime I see that and I feel like there's no risk of the dividend going away, I do like that because I love dividends and getting paid to own a good company. So those are two areas that with banks, I think those three sectors are going to continue to do well. Well, oil hasn't done well, but I think it can do well in 2020. But again, before buying these, everyone needs to make sure they reassess their asset allocation and their risk tolerance before they go into any of these.
Hey, so what about Tesla? Stock's over $400 a share, and you got to wonder, their deliveries were up, I think, about 45% from the year before. They delivered 400,000 vehicles from 245,000 the year before. But isn't this stock being really hyped and overpromised?
My goodness, this is a stock that I just can't figure out. From a valuation perspective, why it's priced as high as it is, I have no idea. I personally haven't touched Tesla. I wish I had, selfishly, because I would have made a lot of money. But to me, it is a high-risk play at this stage, and they just increased price targets on these. Several analysts just did this week, increased the price targets to over 500. And look, here's what I've said about Elon. I'm not betting on it, but here's how I'm not betting against it, because there have been a lot of short sellers that have been trying to short Tesla for a long time. And every time they do it, they get smoked. So
really
I wouldn't
smoked.
touch it personally. It's too aggressive and risky for me from a valuation standpoint.
Yeah, it's funny. Last year, its 52-week low was 100. $177, and it's at 476 right now.
Simply amazing.
Yeah, I mean, that's in 1 year, Eddie. 1 year, that stock is $300 up.
Like I said, I wish I owned a piece of it, but I didn't. And look, it won't surprise me because, as you well know, when these momentum stocks get that much momentum, they usually do just continue to go through the roof until there's some boiling point in which you see a massive sell-off. It wouldn't surprise me to see this thing breach through the $500 mark. But again, for me personally, it's just too aggressive. It doesn't make sense fundamentally to me why that company would be valued as high as it is.
And what's funny, it just 20 minutes ago, MarketWatch said that Tesla's market cap is now bigger than Ford's was at its peak. And
that's exactly right.
That's freaky.
And they do a fraction of the cars.
Yeah, well, they do have that factory opening in China. It's open. It's producing. And so they could theoretically get up to 700,000 deliveries next year. The Chinese will work, they'll work 24. Well, these factories are open 24/7 anyway, the Tesla factories. I just wonder, they make everything in-house other than the tires, but why don't they just sub out the seats and sub out the various other things and just do the guts of the car? Because there's no real money in producing seats in-house. Every other car company in the world has farmed that out, has outsourced it. But yet Tesla wants the whole vertical integration thing. I don't know if that's the wisest thing or not, because they might have hundreds of people working on seats that they could easily outsource that. And it's easy to do the quality control on it. Who knows? Their outsourcer might come up with better ways to make the seats cheaper than it costs them in-house.
I can't agree with you more, but as you and I both know, Elon seems to kind of do things his way, and that would be an interesting conversation to find out as to why they do it that way. They've had issues before delivering cars on time as well, too, and so there could be some hiccups there if they get too much demand, because I think there is a lot riding on China, and it's probably a great market for them to be in, but if they get too many orders and are not able to deliver, last time that happened, you saw quite a bit of a sell-off with that stock.
Well, they're there now, because if you want to post an order for the Model 3, it's 4 to 8 weeks delivery. Wow. That is like, what's amazing about it? They really have upended and totally revolutionized the automobile manufacturing process. Because, and I know the biggest time of year for the big three and all the car companies is the new model year. Tesla really doesn't do model years. Yes, the cars say 2019, 2020, 2018, but in terms of actually a new model year rolling around, they just keep improving the car they have, and they will update them periodically. Supposedly the Model S, they're going to. But, Detroit lived for the new model year, because that would be how they got all these people to buy new cars, because they were sleeker tail fins, nicer headlights, all this stuff. Nothing really earth-shattering or revolutionary in their vehicles. They were just redesigns of the same old stuff.
Yeah, I tell you, it's been, and I have personally noticed seeing more Teslas on the road. I am noticing that. So I will tell you, they have definitely done a great job in regards to branding their company, brand recognition. Because when you talk to someone that has one of those cars, they do love it. It's almost like they have this type of cult following of Tesla, people who love Tesla.
Oh, yeah, they definitely do. For sure. It's remarkable to see what they've done. They've revolutionized it. And like most cars, you buy them, and then the car, it basically, depreciates instantaneously. There's nothing there to actually, what I'm saying is, when you drive the car out of the dealer, you lose 25% of the value of the vehicle. And you might do that with Tesla, but they seem to be able to depreciate them slower than regular cars. So, yeah, it's pretty exciting time to just see that stodgy industry totally upended and turned into a high-tech industry. Well, so
I mean, it's been an unbelievable story, what that company has been able to do. So, and to your point, from a stock standpoint, my goodness, the return it's had in the last 52 weeks is just amazing.
Yep, totally amazing. Hey, well, anyways, and it's the first car company to mass produce cars since before World War II. And that in itself is pretty amazing. There have been many car companies, many people who tried to open new car companies, and they had one thing in common. They all have failed, but Musk somehow not. Well, anyway, it looks like it's going to be an exciting year ahead. Do you keep a little bit of money or some money on the sidelines here just in case there's a correction and you can buy in at a lower rate?
I would, considering the record year we had last year. I am all for taking some profits and leaving some cash on the sidelines. So that way I rarely ever would recommend someone to be fully invested in stock. I think you always need to be in a position, and it's my personal opinion, to be able to buy dips, because as you and I well know, even in a bull market, you're going to have normally at least one or two double-digit drops within that period of time in that year that generally end up being very rewarding if you have the risk tolerance to buy it.
Yeah. Yep, for sure. Yeah, it's risk tolerance, and don't put all your eggs in one basket. Don't bet the ranch. You should be okay. Eddie, we want to find out more about you, follow you on the web. How do we contact you?
Key Advisors Group, LLC.com, and you can follow me at Twitter at Common Sense Bull. All
right. Excellent. Hey, and there's a link in the show notes to Eddie's site. And check out our site, financialsurvivalnetwork.com. The Twitter feed's at Kerry Lutz, Facebook page, Financial Survival Network. Eddie, always a pleasure. Happy, healthy New Year to you and yours, and happy investing for 2020.
Thank you so much for having me on your show again.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.